The live price for Uber Technologies Inc. UBR right now is $92, reflecting a substantial pre-market decline of -7.72% from its previous close, an immediate and sharp negative reaction that is already shaping the day's narrative before the opening bell. The prevailing market expectation for Uber has been one of continued accelerating profit, a belief fueled by a phenomenal year-to-date run and the stock's recent break past the psychological $100 mark. The reality, however, delivered this morning with the Q3 2025 earnings report, is a classic case of the market punishing an otherwise strong quarter due to future concerns, specifically a tepid fourth-quarter outlook that fell short of the street's highly ambitious projections. While the headline non-GAAP earnings per share of $3.11 was a massive beat over the 70-cent consensus, this figure is inflated by a significant $4.9 billion one-time tax benefit. Strip away that non-recurring item, and the market immediately shifts its focus to the forward guidance. That Q4 forecast for gross bookings, while indicating robust 17 to 21% year-over-year growth, is slightly below the most optimistic whispers on Wall Street, and that is precisely what is causing this sharp pre-market sell-off. The expectation was for the momentum to simply continue to compound with aggressive acceleration, but the reality is that maintaining a hyper-growth rate at Uber scale is becoming harder, even with excellent underlying metrics. This is a common pattern in the high-growth tech space where companies like NVIDIA stock or even Tesla stock are frequently scrutinized not on what they did but on what they will do next. The stock is reacting to the whisper number miss, not the actual solid operating performance. The operational highlights themselves are quite compelling, reinforcing the long-term bullish case that many analysts have been making. Total trips surged 22% year-over-year to 3.5 billion, and monthly active platform consumers grew a strong 17% to 189 million. Crucially, the company's core businesses demonstrated excellent health. Mobility gross bookings grew 20% to $25.1 billion, and delivery gross bookings, the once problematic segment, showed even stronger growth, up 25% to $23.3 billion. Furthermore, adjusted EBITDA was a major positive, increasing 33% year-over-year to $2.26 billion. The growth is firing on all cylinders, and the focus on free cash flow generation is equally impressive, coming in at $2.23 billion for the quarter. This is what you want to see from a mature tech platform: massive scale translating into actual cash profitability, a fundamental shift from the cash burn narrative of its earlier years. The issue is that the market had already priced in this success and more. The stock has been on a tear, sitting near its 52-week high of $101.99, a move driven by the anticipation that the company's newfound profitability would allow for an aggressive re-rating of the stock's valuation, pushing it closer to a premium software multiple and away from the cyclical transportation multiple it once carried. The lower-than-hoped-for Q4 outlook has just slammed the brakes on that immediate re-rating process, leading to a classic sell-the-news event, where investors cash in on the run-up, disappointed that the immediate future isn't quite as dazzling as they had hoped. Daily swings of this magnitude, especially on earnings, reveal the volatility still embedded in growth stocks no matter how large the market capitalization becomes. The trading volume today is expected to be substantially higher than its 30-day average of around 14.43 million shares as institutional activity adjusts to the new guidance. We can expect heavy selling pressure in the pre-market to continue into the open, with traders attempting to find a new equilibrium price that reflects the slightly dimmer yet still positive forward view. Looking at the institutional landscape for UBR stock, the picture is complex but leans heavily on a long-term growth assumption. Institutional ownership remains very high, with firms like Vanguard Group and BlackRock holding massive positions, but recent filing data, albeit slightly lagged, has shown mixed activity, with a significant number of institutional investors increasing their positions while a smaller but still substantial number have decreased them. Hedge fund activity has also shown large swings, indicating a fundamental disagreement among sophisticated investors about the stock's near-term valuation, especially as it approached its all-time high. The persistent insider selling, including from the CEO, is another data point the market doesn't love, although much of this is often linked to planned compensation and tax-related transactions. For an individual brokerage investor using self-investing tools like Schwab Intelligent Portfolios or trading directly on a platform like Fidelity or Robinhood, these heavy institutional movements can translate into sharp volatility, making it crucial to look past the intraday noise. The reality is that the core business model has proven resilient and capable of generating free cash flow, which is the ultimate goal. The question for online investment strategies, whether you use a Fidelity trading platform or are engaged in self-investing through a Robinhood app, is whether the dip offers a better entry point or signals the end of the stock's run. Right now, it looks like a sentiment-driven correction following an expectational miss, not a fundamental breakdown. The broader view of Uber's business confirms its solid position as a two-sided platform dominating two enormous markets: mobility and delivery. The original business, the ride-hailing core, is a network effect machine. The more drivers, the faster the pickups; the more riders, the more incentives for drivers. This is the classic moat that is incredibly difficult for competitors like Lyft to overcome. Uber Eats, the delivery segment, has successfully matured from a defensive high-cost investment into a robust, high-growth, and increasingly profitable segment. The beauty of Uber's model is the ability to leverage a single base of drivers and customers across multiple services, driving down customer acquisition cost and improving driver utilization. The freight segment, though small, provides diversification into the massive logistics industry, a long-term speculative bet on digitizing a fragmented sector. Older performance reports confirm the narrative shift that began a couple of years ago, where the focus moved from simply maximizing gross bookings at all costs to achieving sustainable adjusted EBITDA and, more recently, positive free cash flow. The stock's past performance, even through volatile periods, has shown a consistent upward trajectory as the company disciplined its spending and successfully navigated global regulatory challenges. For someone managing a Fidelity IRA or using a robo-advisor like a SoFi Invest Intelligent Portfolio, this shift to sustained profitability is a de-risking event, making the stock more palatable long-term hold, provided the future growth can maintain a respectable pace. Looking forward, the growth story for Uber is now deeply intertwined with high technology and expansion into new areas that will ultimately determine if the stock can retest and sustain a price above $100. One key angle that the market is beginning to notice is the strategic partnership with NVIDIA. This is a crucial link between a leading mobility platform and the preeminent AI hardware provider. The goal, as detailed in recent announcements, is to integrate NVIDIA's self-driving technology into a massive fleet of autonomous vehicles, aiming for a significant deployment within the next few years. This long-term project is about dramatically cutting the primary operational cost, the human driver. And it is the kind of moonshot that justifies a growth multiple. For investors who own NVIDIA stock, this partnership provides a tangible application for their technology outside of data centers and gaming, forging an ecosystem bond that should be closely monitored. Separately, the geographic expansion into underserved markets, a factor often overshadowed by the major metropolitan areas, is also showing impressive internal growth, with mobility in less dense markets growing faster than in the major hubs. This points to a deeper market penetration opportunity that is far from exhausted. Risks, of course, are present. Regulatory pressures, especially around driver classification and compensation, remain a constant headwind globally. The competitive landscape, while less intense than in years past, requires constant spending on incentives and marketing, and the increasingly tight-fisted consumer pressures could squeeze both ride-hailing and food delivery demand. The tension between expectation and reality here is crystal clear. The expectation was for Uber to continue operating like a startup, posting sequential acceleration in growth, fueled by the $4.9 billion tax benefit translating into a perception of even stronger operating leverage. The reality is that the core business is incredibly healthy, cash flow positive, and expanding into profitable new ventures like the NVIDIA-powered autonomous fleet. Yet the immediate future guidance suggests a slight expected deceleration from a monumental base. This is the difference between an emotionally driven momentum trade and a sober long-term investment. For those who invest online, particularly those using advanced platforms like Interactive Brokers trading, the volatility around this earnings release is an opportunity to analyze whether the pullback brings the price closer to its intrinsic value, a value that some analysts project to be significantly higher based on discounted future cash flows, entirely independent of the one-time tax item. This is the time for cool-headed analysis, not panic. The long-term trajectory of the underlying technology and market dominance hasn't changed because of one slightly lower than expected forecast.